you wrote that in one of your earlier issues, you wrote that when you say the USD centric global monetary system is breaking down, what do you mean? So you were asking, I guess, your fictitious client or interviewee, Mr. X, to which Mr. X responded, at the highest levels of global finance, it has long been known that the number one problem in global economics is a dollar-centric system. In other words, that there would eventually be a dollar crisis. So two things to break apart for us. What do you mean by a dollar-centric system, and why is that eventually going to break apart and culminate in a crisis?
Yeah, the dollar-centric system, in short, is the monetary system we have and have had post 1971, where the dollar is the reserve currency and the U.S. Treasury bond is the primary global reserve asset. And in other words, where there are net surpluses earned by trading partners of the U.S. in particular, but globally, some substantial portion of those surpluses find their way into U.S. Treasuries, specifically U.S. dollar financial assets more broadly. And that's the system. Essentially, we send the world dollars. We send the world our factories and our jobs. And then the world uses those factories and our jobs to make stuff and sell us stuff. And we buy those things with dollars and we send those dollars to them. And then they take those dollars and recycle them back into U.S. financial capital markets. That's the dollar-centric system. That system is breaking down, has been breaking down for well over a decade, due to ultimately what has long been known, which is something called Triffin's dilemma, which is when the reserve asset of the world is also the debt of a country. Sooner or later, the debt gets so high after accumulated imbalances are so high for so long that it begins to call into question the solvency of that nation, in this case, the United States. And ultimately, the debt gets so high that the only way the United States, in this case, can keep its debt credible on a nominal basis, in other words, avoid nominal default on U.S. Treasuries, is to print money, is to have negative real interest rates. In other words, in order to keep interest rates below the rate of inflation. That is not a sustainable system. When you have $35 trillion in debt like the United States does, there is no private sector profit motivated investor who is willing to lose 200, 300, 500, 1,000 basis points a year relative to inflation to hold our bonds. And once you get to the point where you need that to happen just to prevent the system from collapse, the system's a dead man walking, and then you need to start moving towards something else. And that's what we've been for a number of years, and certainly post-COVID.
Walk us through the mechanism of the dollar being used less and less globally as a medium of exchange and perhaps even a reserve system to eventually a sovereign debt crisis. What is the from X to Z here? How does that work?
Yeah, so ultimately, when you look, there's two things to think about when you hear dollar dominance. There is usage and there is storage. There is the usage, which is paying for things, and there is the storage of dollars, which is really treasury bonds. That's the reserve asset. So the dominance of the dollar in terms of usage hasn't moved that much. It's still high 80% when you look at sort of total global transactions. That hasn't moved a lot. The dollar's dominance of reserves has fallen sharply, particularly relative to gold, over the last 10 years. Global central banks have sold around $300 to $400 billion worth of treasury bonds on net. In the last 10 years, they have bought about $500 billion worth of gold bullion on net. And so you're seeing this shift away from storing treasury bonds, storing dollars as treasury bonds, towards gold over the last 10 years, as there is a slow move away from this system. Now, within the usage side that I talked about earlier, there is a dynamic where there is a de-dollarization of usage in global commodity markets. Particularly led by China, as well as Russia, some others as well, where historically commodities were only priced in dollars. Over the last 10 to 12 years, that has shifted so that the marginal ton of commodities is now priced in yuan, a little bit in Indian rupees, some other currencies, but primarily in Chinese yuan. This does two things. It does chip away a little bit at the usage of the dollar, but not enough to matter. Where it really matters is it prevents the Chinese from having a 1997 Southeast Asia currency crisis. If China can only buy oil in dollars and commodities in dollars, they're going to buy more oil as their economy grows. They're going to need to, and other commodities. They have a finite number of dollar reserves. The price of oil and commodities goes up. The tonnage of commodity goes up. They run out of dollars with which to buy commodities, and then they have to do like Indonesia or South Korea or any of the other Southeast Asian nations in the late 90s, which is devalue the yuan massively, go into austerity, call in the IMF, and have a currency crisis, high inflation, depression, etc. That is simply a political non-starter for the Chinese. It's a red line. And the way you get around that is you switch the invoicing of your biggest import item, your biggest dollar outflow, which for the Chinese is commodities and oil in particular. You start switching it to yuan. You start getting trade deals with your partners that will sell to you in your currency instead of in dollars. And what that does is it basically preserves the dollar reserves of the Chinese and makes it impossible for China to have a Southeast Asia 1997 currency crisis. So there is some usage erosion of the dollar, but it's very strategic and geopolitical. The real de-dollarization action is happening on the storage side of dollars, where the global central banks have not grown their holdings of treasuries on net in 10 years. They're buying gold instead.
This conversation with Luke Gromen was really captivating, rich with insights into the state of global finance, the challenges facing the dollar-centric system, and the strategic shifts happening in global reserves. The three main lessons from this conversation are: 1. The vulnerability of the dollar-centric system. Luke Gromen highlights the weaknesses of a global monetary system reliant on the US dollar as the reserve currency. As the US debt continues to rise and global economic imbalances deepen, the sustainability of the dollar's central role is increasingly in question. According to Luke, the system is facing a Griffin's dilemma, where the only way to sustain credibility is through inflation and negative real interest rates. 2. A shift in reserve holdings. Away from treasuries. Over the last decade, central banks have been gradually shifting away from holding US Treasury bonds as reserves, moving towards gold instead. Luke points out that global central banks have sold hundreds of billions in US Treasuries, while accumulating around $500 billion worth of gold. This change signals a growing skepticism about the dollar's long-term stability and an effort by countries to diversify their reserves. 3rd, geopolitical moves to reduce dollar dependency. Luke discusses how countries like China are strategically reducing their reliance on the dollar by pricing commodities, particularly oil, in yuan. This shift not only insulates China from a potential dollar shortage, but also chips away at the dollar's dominance in global trade. It's a move that allows countries to avoid financial crises like those experienced in Southeast Asia in the 1990s. So, what do you think about this discussion on the dollar's future? Do you agree with Luke Gromen and his insights? Let us know in the comments section below. If you enjoy this type of content and want to see more, make sure to give this video a like and subscribe to our channel. Until next time, keep learning and keep stacking.